All right, what's going on, everybody? Welcome back to the channel. It's Millennial Trades. It's January 15th, 2023. We've got a lot of good stuff to talk about in this video. I want to talk about some of the warnings coming from the global financiers. We have statements from Larry Sommers and Fed Chairman or St. Louis Fed President Jim Bullard. We've got very, very serious comments coming from the global financiers, so we got to hit that. I also want to talk about the bank earnings a little bit more, especially when it comes to JP Morgan. I kind of just briefly went over them on Friday's video, but I looked a little bit more deeply into these bank earnings, and the banks are stacking cash. The question is why? And it does actually remind me of some of the liquidity issues from this book, Too Big to Fail. Also, the debt ceiling. I haven't even mentioned this on my channel before. I've been, somewhat aware of the fact that there is a debt ceiling debate coming up, a negotiation. They're most likely going to raise the debt ceiling, but what are both sides of the aisle going to have to agree to? I want to talk about that. And are they going to cut spending? That's really the big question here. So we've got some great stuff in this video. Markets generally. Oh, hold on. How do I turn that off? Where did that come from?
It's good to see you, Doug. I haven't seen you in a while. And, boy, I don't know. This story...
Where is this coming from? Okay.
ESPN would be spun on.
Sorry about that, guys. So, maybe that's what was lagging up my video, the last take I was trying to do of this. Sometimes I do like 2 or 3 takes of these videos to get them right. So for those of you watching, thank you for being here. It means a lot. Thank you for the support, the comments, and the likes. Before we get into these topics, just something I wanted to mention real quick. I actually watched the movie of this book. And in the movie, Dick Fold of Lehman Brothers is played by James Woods, I think is his name. He's the conservative commentator on Twitter, right? In this movie, James Woods, who's playing Dick Fold of Lehman Brothers, there's one scene, and I don't remember reading about this necessarily, but there's one scene where he calls some other bank CEO a Nimrod, and if you guys know what Nimrod is, that's an ancient Babylonian deity, and then he goes on to say, our stock was, because their stock price is plummeting in the movie. He said, our stock price was $66 6 months ago. I'm just thinking to myself, like, does anybody else ever notice this? Am I the only one that ever notices this kind of stuff? Because sometimes I feel like I am. In a financial movie, in a movie about bankers, within 20 seconds, they mention Nimrod, an ancient Babylonian deity, some sort of satanic god, and then they say basically 666, right? Our share price was $66 6 months ago. You can't make this stuff up, guys. But, I see it. I know some of you guys see it. I know some of you guys are looking for the esoteric. You're looking for the numerology and the symbolism within the financial media, and you see it too. So, but I thought I'd mention that, and I don't remember specifically reading that. But I don't know. I've taken so many annotations in this book. This book, Too Big to Fail, is really great. Andrew Ross Sorkin, I don't think intentionally was writing the book for this reason, but he really lays out for us, all the connections between Treasury, Fed, deep state, the banking cartels. It's a revolving door. I mean, if you read this book, you will be shocked at just how many connections the Bush administration had. Bush had cousins working in Goldman Sachs, and Hank Paulson, the Treasury Secretary, spent 20 years at Goldman Sachs. It's no wonder these banks got so much support. And they try to make it out to be like, well, they're helping us, right? They had to bail out the banks because they were too big to fail, and Americans would have been worse off had they not. Whether that's true or not, I guess that's up for debate. I'm not saying that it's not true. I mean, these are people that are put in these very powerful positions, probably by some sort of divine power. Whether or not they're wielding it correctly or to our benefit is another question. But this book is just, I can't wait to, I'm about halfway through this book. I cannot wait to finish it and then just do an entire review of the book. The thing about the movie is they didn't have enough of Aaron Callan. There was like one scene with Erin Callan. I don't know which actress it was. They had some pretty good actors, James Woods, Helen Mirren. But yeah, they had like one scene with Erin Callan, and I was hoping she'd be a little bit bigger part of the movie because she's a pretty big part of at least the first half of this book when she was CFO of Lehman Brothers. If you look up Erin Callan on YouTube, you'll see her being interviewed by I think her name is Danielle Bombardi or something. But just type in Erin Callan on YouTube if you want to get a gist of like what the Lehman Brothers scandal was all about. She was basically a diversity hire from Dick Fuld. Had no idea what she was doing as far as high corporate finance. I think she came from tax law or something, but she just wasn't qualified to be handling the books of Lehman Brothers, and she just straight would like lie on television about their capital position and their liquidity. And I guess maybe within the Wall Street circles, she was somewhat of a almost like a sex symbol. In the book, it talks about how she would wear stilettos and was influenced by Sex in the City. I guess that was a show she really enjoyed. So, and then she came out about 5 years later, probably back in 2013, 2014. She came back in the media real briefly because she disappeared after she had to resign from Lehman Brothers just months before their complete collapse. But she came back and told the mainstream media that women are leaning in a little bit too much, and that she had missed out on everything from just relationships to having children because she was chasing this sort of corporate career, and she made this warning to women about that, about choosing career over things like family. And the mainstream media kind of try to slander her as an anti-feminist and all this kind of stuff. But very interesting story. To me, Erin Callan is one of the most interesting characters in the Too Big to Fail story. But anyways, that being said, we've got some statements from Treasury Secretary Larry Summers, or the former Treasury Secretary, and St. Louis Fed President Jim Bullard. Now, before I even talk about the comments, the uneducated economist talks all the time about the concept of credible threats. I will leave a link in the description down below to a speech from Bernanke from back in 2001. They realized back in 2001 that interest rates would not always have the same effect that they have in the past, and that the Fed needed to start using credible threats, which is basically manipulating the market based on things that they say, do, or don't do. And I really got to put it out there for the uneducated economist because I'll actually leave the link in the description below for his recent video about this. But he's brought up credible threats on his channel. This is actually how I know about the concept of credible threats, because he found this Bernanke speech from 2001. And so essentially what a credible threat is, and the Fed admits to this being a tactic. This is one of the tools in their toolbox when it comes to controlling inflation, cooling down the job market. It's basically propaganda, right? They by just saying they're going to do something, they don't necessarily have to do it, but they believe that, the theory is that the market will react to whatever the credible threat is, right? So this was kind of, I guess maybe disproven when the Treasury Secretary, Hank Paulson, had pushed for all of this, regulation, because Hank Paulson back in 2008, the Treasury Secretary, he had spent like 20 years at Goldman Sachs, and he had spent a lot of time trying to deregulate Wall Street, right? But as Treasury Secretary, he goes back on all of that and tries to get more regulations and gets more and more power for the Treasury. And they talk about how he wanted to have a bazooka in his pocket. Not that he necessarily had to use it. This is what he told Congress. But he needed the authority, to write blank checks and to bail out entire failing banking institutions that he happens to be friends with and has family members that work for, and all this kind of mess. But the whole credible threat idea, though it may not actually be, I guess it's debatable whether or not the credible threats are as credible as the Fed wants us to believe. But for instance, when they say that they're going to buy up the bond market, right? This happened after the crash in 2020. All they had to do was say that, and investors supposedly went in, front-runted the Fed, and propped up the bond market. So every time they say something, and here's the other thing too. At one point in time, the uneducated economists talked about this, and I think this was fairly recently, but at one point in time, I think it may have been Jerome Powell. He said that they were no longer going to use credible threats, which in and of itself is a credible threat. Like once you start using credible threats in your toolbox, there's no going back, right? Once you start using propaganda as a tool to control the markets, there's not really any going back from that. Even if you say there is, that in and of itself is a form of the propaganda. And so what the Fed essentially is trying to do, this is what uneducated economists makes the argument for, is that they're not necessarily trying to control through interest rates, right? To control the economy. They're trying to control the economy based on things they say and do. Therefore, they could bring the interest rates up, let's say, past 5% at the next FOMC meeting by 25 basis points or maybe 50 basis points. But the fact that they maybe put it out there that it's a range between 25 and 50 basis points, and then they only come out with a 25 basis point rate hike, right? All of this is part of the credible threat theory, the propaganda, right? If they come in lower than 50 basis points, then the media or then the markets have a certain reaction to that. They want the markets to basically be in tune with the Fed. That's the whole point of credible threats. I hope I'm articulating this correctly. The whole point of the credible threats is for the market to be in tune with what the Fed is doing. That's what they want. But then when you think about how they claimed that they weren't going to use credible threats anymore, which in and of itself is a credible threat, right? Because the market's going to react to that news too. It makes you wonder, do the credible threats come just from the Fed, or could they come from former Treasury secretaries like Larry Summers? I would make the argument that the credible threats probably come from former state operatives like Larry Summers, because, as it's laid out in this book, Too Big to Fail, you had Kramer. This is one of my first annotations, at least with the sticky note. The Kramer connection. You had the state and Ivy League schools, people who knew each other through Ivy League schools and banking, collaborating with the media to mislead investors, right? You had meetings between Lehman Brothers and Kramer from CNBC, where they were literally talking about how they could, somehow spin the Lehman Brothers story to sell it on the media to try to boost up the stock price. It is all laid out here. I don't think Andrew Ross Sorkin necessarily was trying to expose the connections between banking, state, media, but he did. It's all in the book if you know how to, read it. So when former Treasury Secretary Larry Summers comes out and warns that a recession is still more likely than not, and to be careful of false dawns, right? Is this in and of itself just a credible threat? Is it another piece of propaganda in this, state banking media machine? But I think the fact that the former Treasury Secretary is telling the markets to be careful of false dawns, is he warning? Is he hinting? Is he predicting? Is he telling us exactly what's going to happen? False dawn basically means that, inflation looks like it's coming down, or the economy looks like it's getting better, or the housing market looks like it's not about to crack. And then a couple months later, things just get even worse than they were, before the recent bear market rallies or whatever. It kind of goes along with what Bullard said. St. Louis Fed President Jim Bullard last week said that inflation won't necessarily go down in a straight line. In fact, that it's unlikely to go down in a straight line. I think about any sort of chart that I'm watching. It could be a stock chart, a crypto chart, oil ETFs. It could be any instrument, bonds, foreign exchange, inflation metrics. It doesn't matter what you're looking at. None of this stuff goes up in a straight line, and none of it comes down in a straight line. I think that's a pretty good indication here, guys. Even if they're credible threats, or even if they're trying to push the markets one way or the other, the former Treasury Secretary Larry Summers says, "Be careful of false dawns." Just a day later, after Jim Bullard from the St. Louis Fed said that inflation won't go down in a straight line, they're talking about the exact same thing, a potential reversal where inflation gets even worse. Now, global inflation has been coming down. We know this because global trade and the valuations. Not necessarily the volumes, because the volumes are low anyway, but the valuations of global trade is coming down. You have, for instance, exports from China to the U.S. and Europe way down. The shipping companies are saying that Europe is already in recession just based on the value of the products that they're shipping from China. So all of this is very serious, but we can't just look at the Fed when it comes to inflation, because there are even bigger macroeconomic reasons for why we may be experiencing disinflation, inflation, deflation, and deflation would be even worse than inflation. I won't get into that theory in this video. So they want to raise the debt limit here in the United States. Debt limit showdown, how the upcoming negotiations could play out in Congress. This is coming from Forbes. The federal government will reach its borrowing cap, known as the debt ceiling, as early as Thursday. So this is a big event. Now, a trader from my church today that I was speaking with, he said that this could move the markets, right? If they raise the debt ceiling, it could move the markets. If they don't end up raising the debt ceiling, that could move the markets as well. This is a pretty big event, and I haven't ever mentioned it on the channel. But the Treasury Secretary, the current Treasury Secretary, Janet Yellen, says that the Treasury will have to take extraordinary measures. This is her quote: extraordinary measures to meet its financial obligations just over the next few months. Not counting the next few years. So essentially, they, in theory, could default on bonds. Obviously, they don't want to do that. Obviously, the debt ceiling most likely is going to be raised because, we're in a debt hyper bubble. The whole system of the beast is based on debt. It's a debt-based system. Gregory Mannarino talks about this all the time. It can't exist any other way. We don't have a wealth-based, value-based economic system. We have a debt-based system, credit-based system. So Republicans will probably end up going along with this. Obviously, they go along with everything else the Democrats do. We're in a sort of uniparty environment, even though it looks like two parties. Congress will need to raise the debt ceiling to prevent the government from defaulting on its obligations for the first time in U.S. history. Some Republicans plan to ask for spending reductions, reforms to entitlement programs such as Medicare, Social Security, sweeping changes to President Biden's policies in exchange for a debt limit increase. Now, Trump is out there on Truth Social, saying that the Republicans can kind of undo a lot of Biden's economic policies through a deal to raise the debt ceiling. So it's going to be interesting to see how this plays out. But Janet Yellen warning lawmakers that her ability to avoid a default, which she claims is going to just wreak havoc on the economy and threaten key spending programs, could end as early as June. So is Janet Yellen telling us the truth? Maybe the better thing to do would be to default on some. We know individuals are going to be defaulting. The banks, this is why they're stacking up on cash, is because individuals will be defaulting on mortgages, credit card loans. But the Treasury is telling us we absolutely can't do this. We just have to continue to raise the debt ceiling. And this is what they're going to say, until the end of, till it finally pops. I think since 1960, the debt ceiling has been raised 78 times. I'll leave the Forbes article in the description down below. You guys got to check this out. It is just wild. Again, another article from Forbes. U.S. could run out of cash by early June if the debt limit isn't raised, Yellen warns. So if they don't raise the debt limit, they're claiming, everything's just going to freeze and there's going to be bank runs. And remember, we talked about the FDIC insurance regulatory meeting in a couple videos back. I think I did a short of this too, where the FDIC is basically saying they have no confidence in the banking system and they realize the whole thing is, propped up by nothing. They're trying to insure, I think, $7 trillion worth assets with only $150 billion. I mean, that is just crazy. And they say in this regulatory meeting that you don't want to put this out there to the public, for non-professionals, people who don't need to know, just don't tell them. That's what essentially they said at this regulatory meeting. And now you have Janet Yellen saying that we may actually run out of cash. So this is pretty serious stuff. Again, could all be credible threats, right? I mean, if Janet Yellen is saying we're going to run out of cash by June, that's even if it's not true, it's a credible threat. So again, check out the Bernanke speech. I'll link that down below. They were discussing credible threats publicly all the way back in 2001 because they knew the interest rates didn't have as much of an effect on the economy as they'd like us to believe. And then, now that we're, at least on this channel, considering global trade, and the influence from global trade on inflation, maybe the Fed, maybe we can't just blame the Fed for the high prices or blame the Fed because the CPI numbers are looking better. Speaking of global trade, China's trade tumbles sharply in December, clouds 2023 outlook, okay? So, wow, we're over 20 minutes into this video already. I hope I'm making sense, guys. I really hope I'm making sense. I'm enjoying a couple of shots of Jägermeister this fine Sunday evening. China December exports worst since February of 2020. Imports tumble by a smaller margin amid lackluster demand. Domestic demand should slowly recover after zero COVID scrapped. So China exports are down. What does that mean? That means that demand, especially in the West, is down. Now, I believe their exports to Russia are actually up nearly like 40% or something, and we know what that's all about. There's new agreements being made that sort of exclude the U.S. dollar system or work around the U.S. dollar system. So that's what that increase in exports to Russia is all about. But their exports to the U.S., exports to China. I mean, I have all the stats written down somewhere in my notes from the last couple of days. We talked about it in a previous video. I don't want to harp on the numbers too much here, but yeah, I mean, the point is that the demand is basically fallen off a cliff or starting to fall in America, in Europe for these Chinese exports. So the valuations are coming down. Now, with China's exports and imports, or their exports, they don't give us much information on the volume. So all of that is kind of estimated by the World Trade Organization. But they do let us know about the valuations, and we know the valuations because we're paying for them. The valuations are coming down a lot, which means the demand has to be, there has to be some effect because of the demand. All right. And, that makes sense with everything that's going on, things tightening here, with the monetary policy, things tightening in Europe with their monetary policy, the cost of borrowing getting higher and higher. It makes sense that demand for products is down, at least by valuations. And I did a whole video about this yesterday, the effect of global trade, the differences between value and volume, the fact that volume never really recovered, even from the 2008 financial crisis, but that valuations, skyrocketed, which would indicate that's actually not a real recovery. And so the valuations coming down, the volume still being sort of low, no actual real recovery spells out recession. And I think, you can just kind of see what the global elite are telling us. They're giving us hints. Even the IMF is saying 1/3 of the world's going to absolutely be in a recession. So, real quick, commodities. I mean, crude oil right now, just under $80 a barrel. If we crack this zone and start rallying, it'll be exciting. But until we crack $80, $85, there's not really much to talk about. Not much of a rally, at least. Same thing with gold. I mean, this is how I feel. Until gold's at 2,500, I mean, what are we just going to keep quoting the price of gold every day on our videos? No, but I'm paying attention to some of these things. It's interesting to see gold up so much and silver not really keeping up, but it's also a testament to how undervalued silver is still. despite all of the manipulations from JP Morgan and everything else. So, I noticed this too on my headlines. U.S. import prices unexpectedly rise. Now, this came out 59 hours ago, but prices for U.S. imports rose 0.4% from a month earlier in December of 2022, following a revised 0.7% decrease in the previous month. So, I need to start paying attention. We all need to start paying attention to imports, exports. It's something I've just recently started getting into. But if you think about it, it's much bigger than the Fed. Global trade is much bigger than the Fed, even just as an institution. So if global trade prices come down, well, that would make sense why we're seeing a downturn in the CPI reports. But if our imports are going up, our exports are going down, or if China's exports are going up, all this we have to pay attention to. That will, if we start seeing our imports, the prices for our imports rising, well, it's kind of like a no-brainer. We might see inflationary pressures here in the United States on our prices. So something to keep in mind. JP Morgan tops estimates for fourth quarter revenue, but says mild recession is now central case. Now, I talked about the earnings here, right? We had earnings of $3.57 per share from JP Morgan. They had a $35.57 billion revenue versus the $34 billion estimate. Now, again, these people could be lying. This could be propaganda. It could be credible threats. Who really knows? And if you don't think the commercial banks, if you think it's just the Fed that runs the credible threat programs, I highly doubt that. I mean, just from reading this book alone, we know the mainstream media puts out the credible threats, right? We know that the commercial banks are in tight, very close communication with the Treasury. And so, even JP Morgan, Jamie Dimon statements, I think it's a form of credible threat. It's a form of propaganda. Nothing we see is real. Everything we think is real on the surface, there's some deeper level meaning. And you have to cut through all of the Ghoul speak, all the Ghoul talk, the Fed Ghoul talk, the EBC Ghoul talk, the commercial banking Ghoul talk, the stock market Ghoul talk. These Ghouls, they sort of talk from both sides of their mouth, right? But JP Morgan on Friday posted fourth quarter profit and revenue that topped expectations. Well, yeah, if they make the expectations real low or lowball the expectations, topping the expectations, that's great. But how do we know the expectations were appropriate? Interest income at the bank surged 48% on higher rates and loan growth. So you can see a distribution of wealth going on here. But what I really want to get into, they said their profit jumped 6%. Very interesting. Their profits, right, which is really where it counts, jumps 6% from a year earlier. To 3.57 per share. Revenue rose 17%, all right, fueled by the rise in interest income. But the bank also saw average loans rising by 6%. But here's the key. The bank posted a $2.3 billion provision for credit losses in the quarter, a 49% increase from the third quarter. So they went from $2.3 billion cash position, liquidity, from $1.96 billion just a quarter before that. And this wasn't the only bank. I think Bank of America as well has stacked up on cash. Wells Fargo's profit was like way down, or their maybe it was their revenue. Wells Fargo's having some issues, but they as well are trying to raise capital and liquidity. It reminds me a lot of too big to fail, right? I'm not exactly sure what it means, but all of these banks in too big to fail were scrambling for cash because they were all tied up in these bad mortgage, collateralized debt obligations, these mortgage derivatives, and these banks were like $2 billion, $3 billion, $5 billion in the hole. And a lot of them failed. Bear Stearns, Lehman Brothers, Fannie Mae, Freddie Mac, the housing insurance companies, or I guess they provided liquidity for loans. All of these companies, they either had to be nationalized or they went under. And it's kind of eerie when you have JP Morgan raising so much provisions for potential credit losses, because I think they know that we're going to see massive waves of defaults, whether that's mortgage defaults, credit card defaults, student loan defaults. Somebody has to hold the bag for this. And it is going to be the banks, right, at the end of the day. If millions of Americans default on credit cards, for instance, or on their Chase cards, JP Morgan needs cash to absorb these potential losses from all of their different credit products. I mean, that's the way I understand it. If I'm wrong, please correct me in the comment section down below. So we will be paying attention to that. Here's another article from The Hill. U.S. households' debt rises to $16.5 trillion. The average household owes more than $165,000 in debt. Now, obviously, some of that's probably mortgage, but you think about the student loans, the credit card debts, the auto loans. I mean, it just never stops. The buy now, pay later programs. Remember when PayPal and Square and all these fintech companies were coming out with buy now, pay later, at the height of the pandemic? I mean, just so irresponsible. Some of these companies are facing issues now, too, because people can't pay this back. It's my mind is kind of spinning now just thinking about all of this stuff. But yeah, I think we should heed the warnings, right? We talked about Treasury Secretary Larry Summers' comments about false dawns. We talked about Jim Bullard's comments about inflation probably won't go down in a straight line. We talked about the debt limit needing to be raised, and Janet Yellen saying that it's gonna wreak havoc on the U.S. economy if we don't go deeper into debt, right? Which to me fundamentally, that doesn't seem to make sense, but that's what she wants us all to believe. She also says we could run out of cash by June. You've got global trade pulling back 9.2% since June. U.S. import prices unexpectedly rising the last month, so we'll have to pay attention to that and how it affects inflation. JP Morgan stacking up on cash, Bank of America, Wells Fargo, all these banks stacking up on cash, getting ready to absorb massive, defaults. And U.S. household debt just continues to expand. Where does all this go in the end? We may not see the debt bubble pop in our lifetime. It may not even be in the next generation's lifetime, but eventually the debt bubble will pop. Nothing can go up in a straight line. I mean, even Jim Bullard says this. So, you can continue to raise the debt ceiling. You can continue to go, $35 trillion in debt, $40 trillion in debt, $100 trillion in debt. I don't know exactly when the bubble will pop, but eventually it will pop. There will be a sovereign debt crisis. It could take 100 years. I'm not saying it's going to happen tomorrow, but to be naive of any of this, and to not at least consider the possibility of what we're facing, what the next generation is facing, I think is irresponsible of all of us not to at least consider it. Last thing I'll end with: bond traders set to test Bank of Japan ahead of key policy decision. Their central bank governor, his name is Kuroda. They're thinking about scrapping their yield curve control measures. Remember, I talked about how they raised their range from 25 basis points to 50 basis points. I think it was on the 10-year yield for the Bank of Japan. Well, they're thinking about scrapping that yield curve control. It's obviously not really working, to calm down their inflation. But they're having a 2-day monetary policy that starts on Tuesday and ends Wednesday. Markets are considering the ramifications of Japan finally moving away from the ultra-loose policies that have defined its 20-year battle with deflation and made it a global source of cheap funding. So, going to be loosely paying attention to what's going on in Japan, what's going on with the yen this week, because it may affect some of the markets. We've got the PPI coming out. We've got some housing data coming out. So we're going to talk about all of it in good time. I will leave it there. You guys enjoy the rest of your evening. Thank you so much for spending some of it over here on this channel with me. If you enjoy these videos, give them a like. Leave your thoughts down below. You can follow this show on BitChute, on Rumble. Follow me at Millennial Trades on Instagram. And as always, until next time, I'll see you on the next video.